Sunday Night Futures Live. This is Bob Desmond, and we're going to be talking about Friday. Did NVDA see a top? Did the NASDAQ composite see a top? It's all the buzz all over Twitter sphere that given that price action on Friday, stocks got to go down. We're going to put a little bit of we're going to put some brackets around that. We're going to put it into context about what you may not want to do, and you may not want to go getting net short that quickly. You want to be very, very careful when entering a short position because it is a very, very risky bet, far more risky than buying equities, especially when you're in a bull market. We're going to talk about some investable areas that are looking really, really good, and they have just begun to move. And one of them, actually two of them now, are outperforming the S&P 500, at least on a monthly time frame. That hasn't happened in a while. So let's take a moment. The futures markets are open, and we're going to let them settle down. And I'm going to take a moment to say hello to folks. Wow, a lot of people. Whoa, look at this. Mike C, AMD Demand Zone. That had a rough day. Hey, brother. We will be watching SMCI as well. I went over it. Thank you for bringing this up. I went over SMCI in best stock charts. I just posted it on YouTube only a couple of hours ago. That's the freemium version. The premium version without the members. We do plan on yet again shorting SMCI using a call spread strategy. That worked for us last week. We actually used an iron condor strategy last week, but skewed to the short side, and that expired worthless, which is good because we're option sellers of SMCI. Why? It's because they're pumping up the value of these options to a ridiculous rate, and we're just going to sell them, and it's working out well. Franklin, you've been quiet of late. Welcome. Good to hear from you. Seymour, thank you, sir. Appreciate that. Dane, hey, brother. Yeah, Meta, big reversal bar on Friday. From what I understand, Zuckerberg continues to sell a lot of shares every single day. So something's going on there in the C-suite. Pete, Mr. Pete, welcome. Bank stocks will move higher if Trump returns to cutting regs, financial sector. I happen to like the banks. I mentioned on best stock charts that that I ran a screen, and it's, usually I run a Bollinger Band screen, and usually you get a lot of tech stocks, a lot of high beta stocks. This time around, a lot of banks, a lot of realty companies, a lot of energy companies, broad-based. So there's a lot of opportunity out there setting up to the long side. So I do think that the banks are going to continue up higher. The only caveat out there is you need to keep an eye on the KRE. That's the Regional Bank Index. On Monday, that Federal Reserve program, which has been bailing out the regional banks, I believe that expires unless they did some Sunday night special and extend it out somehow. So just beware. Regional banks, watch them this week. Trader Isaac, welcome. Corey, welcome. Yeah, we can go over Newmont. I went over that a couple of times last week. I like it. I know the CEO came out a couple of days ago saying that his stock was the cheapest he's ever seen it. Rarely do CEOs say that. Granted, he's got a vested interest in doing that, but usually they won't do that because they're afraid of getting sued. So there should be a little bit of element of truth in that, and I believe him. There's the pen. All right, so we got Newmont. I have a bunch of members chart requests to go over. Talent, hey, brother. What about the Fed turning off Fed? Yeah, I was just talking about that, Kelly. That's a big question mark because they've been drawing on that lending facility, meaning the regional banks, at the highest rate since 1 year ago. So it's not as if the regional bank crisis has gone away. The Federal Reserve has had them on life support. So I don't know what happens this week. We'll know on Thursday, because Thursday is when they release the. Well, they're not going to release it anymore. I worry about a headline risk event there. I really do. Watch watch that. What is it? New York Central, whatever it was, the one that blew up last week. NYC. Do I still have it up here? No, it's gone. Watch that bank. I think that bank is in a lot of trouble. Smash the like button. Yes, thank you very much. I'm a horrible YouTuber. I always forget that. Thank you to the audience for always remembering. Metaforming W formation, 30-minute chart, starting to form on Friday. A lot of the market did. A lot of we need to keep in mind if the market, S&P 500, meaning the market, bottomed out in the morning, and it just consolidated the rest of the day. So I fully expect, as a matter of fact, we're up fractionally here. Let me share my screen. The futures action is open. Where is my screen share? And we are here. Okay, let's do it. So I don't know why. Futures highlight extended hour. Okay, so here's where we close. I'm not sure why this is showing as down. I think it means that it's down off of its highs, but relative to the close on Friday, we are up. This is the E-minis. So a big gap out of the gate here for the E-minis. Let's check out the NQ. That's the NASDAQ 100. NASDAQ 100. Up, same deal here. We were up measurably higher. Now we've reversed. It's showing us down spot 26%. In reality, we are up relative to the close of Friday. Taking a look at, do we have the RUT or the Dow? Which do we want to go to first? RUT or Dow? RUT. All right, so the Russell 2000 gapping up, showing is down. I can't stand that. It drives me crazy. But it's showing is down. But relative to the close on Friday, we are up. And this is a good thing from a short perspective. Dow Jones, industrial average, gapping up off its highs. So in the early goings here, we have the futures action up relative to the close on Friday. Now, last week was not a good week for the US dollar. At current, it is not looking all that bad. And frankly, it didn't look all that bad on Friday afternoon. Friday morning, however, it was abysmal. And at current, it appears as though we want to tick up higher here. I don't think that it lasts. The reason is that yen just ripped last week, and that is not good for the dollar because the euro is looking strong as well. Let's bring up those other currencies, and we'll take a look at them on a weekly time frame rather than a intraday time frame to give you context of what I'm talking about here. We'll begin with the yen, and here you have a higher low. Now, for those not familiar with why I'm going over the Japanese yen in a minute, the euro, the reason is that out of the Dixie basket, the DXY, the two major currencies that trade against the US dollar, euro, yen, Euro is about 55% of the Dixie basket. Yen, measurably smaller than that, but a major component, the second largest component. So as these names go, so goes inversely the US dollar. And you can see here on the yen, we have broken out. Does that mean we can't do a retrace, touchback, and retest these support levels? Sure. But longer term, the yen appears to be doing something after many, many years of being in a downtrend. Could this just be a multi-month, multi-week rally? Sure. Sure. I mean, they're just as much of a basket case as we are in terms of zombie companies. Yen last week, a good week. It is also broken out. So these currencies relative to the dollar, let's bring the dollar back up. Here's the dollar last week. Which do you want to own, dollar or euro? I'll take the euro right now because the dollar, for all intents and purposes, is now in a brand new downtrend. And that top was put in back here in September of 2022. And it looks as though we're getting ready to break to new lower lows. So with that brings a whole bunch of opportunity. And those opportunities we're going to be talking about in a little while, because I have some great charts to go over. Now, going back, let's stick with the commodity arena weekly chart for a moment. Let's take a quick peek at agriculture, corn. I mentioned last Sunday that it looked as though we had put in the bottom. We were probably going to rally. Not only did we rally, we broke out last week. Taking a look at soybeans. Soybeans, same deal here. We got the rally and it broke out. Why does this matter? Why do we go over this? We look for inflation. We don't want to worry about having to wait until next month to get this month's CPI data or PPI data or PCE data. I want to know what it's doing every single week of the month before we get that data. That way we can be positioned for the ultimate outcome and then everybody else can react to it. So ag prices are somewhat muted. I don't think wheat rallied last week. I think that closed down, and it did. So no trifecta here. Wheat remains in a downtrend. Now, taking a look, let's go back to a 5-minute chart. Let's take a look at energy. As I mentioned earlier, when I ran my screens this morning, I had a ton of energy stocks that were populating as bullish calls. But the problem with energy is that if you're going to buy these energy stocks, you want to make sure that oil is going up as well. So that's what we're on the lookout for now is what's oil doing? If oil looks like it's getting ready to press up higher, well, we want to buy energy stocks like Apache. I profiled today. I also profiled FSLR. That's looking good, but you also need higher oil prices because that makes solar a lot more affordable. So First Solar looking good, Apache looking good. The only thing that's missing right now is a breakout on oil, but we are in an uptrend. We had a down week last week, but once we begin to break out through this overhead supply zone, look out above. Let's check in with Nat Gas. So Nat Gas had been on a tear, but last week it caught it on the chin a little bit. It's up at current 1.27%. This is last week. So what we're looking for here is a higher low. We no longer have a position on Nat Gas. Nice move up higher. You have a bit of a Bollinger Band squeeze on a 15-minute chart. That Bollinger Band squeeze began here, failed to the downside, or resolved to the downside, I should say, then rallied back. Looks as though we're going to press up higher on nat gas after that sell-off. Yeah, Bollinger Band squeeze on an hourly chart. I think nat gas moves up higher. Let's take a look at precious metals. Now, gold is obviously in fuego. A lot happening here. Here's the week. We have a lot to talk about with regards to gold tonight. The thing to keep in mind is that gold at current is a bit overbought on a very short-term time frame. So would I be a buyer here? As bullish as I am on gold, would I be a buyer here? If I'm going to buy it for and hold it for the next couple of years, then buy a little bit, leg in, no big deal. If you're doing it for a short-term swing trade, no, I would want to see it pull back and then get in on an orderly pullback. Maybe you see a spike in the dollar for a couple of days. That'll bring gold in, and then that's your opportunity to step in. But a major, major breakout here on gold. It cannot be ignored. A new closing all-time record high. What's lagging, and we're going to talk a bit about more later on, is silver. Now, silver has broken out, but in relative terms to gold, it is underperforming by a wide mile. Nowhere near all-time record highs. The reason is that you don't have central banks that are buying silver. They're buying gold. So you don't have that bid by the central banks. However, is that retail has been selling gold in recent days, and you had the central banks buying it up. Once you get the hedge funds in there who are very under invested in gold and don't want to pay up for gold, they're going to find a home in silver. So eventually silver is going to play catch up. And usually, a top in gold is when silver is then outperforming gold. So gold is looking great. Silver is looking dirt cheap on a relative basis. We have a great chart of that in a few minutes. Live cattle. Finally down week. What a rally this has been. New all-time highs. Damn. Okay, that price has got to come in. Home heating oil, not much happening there. All right, let's get to it. Let's go to comments. You guys are monsters tonight. Lots of comments. When gold was $1,000, silver was $50. Now gold is $2,000 ounce, and silver is about $25. Yeah, as I just said, Pete, I think that silver has got a lot of catching up to do. The utilization for silver is far greater than what it is for gold. I mean, the industrial uses for silver are huge nowadays. So it's a precious metal. It's also an industrial metal. So I think that ultimately when gold becomes even more overbought and people don't want to pay the bid, then you're going to have to go to silver, and silver is going to play catch up. So right now, silver is pretty cheap. I'd be a buyer of silver. We own it. I'm going to buy more. Major pumping up at the crowd earnings. Can you please check the charts and see where to from here? Yeah, we could do that. I like CrowdStrike. It's an ugly chart, though. I don't think it's time yet. Okay. I think a tech correction could happen next week, like last Friday. I have a few charts to talk about that. Listen, here's the thing. The first thing that we need to do if we want to be successful in this business is just admit up front. I don't know. I don't know what the stock market's going to do, up, down, sideways. I have no clue. I have an idea. I'm using my charts, but in the end, we know nothing. All we do is try to derive an edge out of understanding what the chart looks like and understanding the why behind the chart looks that way. One of the reasons why you saw the NASDAQ composite, in particular the triple Qs, get hammered on Friday is because their leadership names, well, they just buckled. You haven't had Tesla, you haven't had Apple, you haven't had Google. Oddly enough, I think two of those three at a minimum were up on Friday, yet NVDA, Broadcom, those names which have been leading that sector up higher took a dump. This whole semiconductor space took a dump. So you had way too few stocks leading the equity markets up higher. And once you get selling in those names, the whole composite comes down. It's a foregone conclusion that that's what's going to happen. So in a bull market, I'm going to go over a comparison of today versus 2000 daily chart. We're going to talk about bearish key reversal bars. If you don't know what that is, that's what we saw on Friday on the candlesticks. I have a 5-part video tutorial, my top 5 favorite candlestick patterns, free if you want to learn them. We're going to do a comparison because a lot of people are on the Twitter sphere right now saying, that was a top. Friday's a top. They're speaking in absolutes. When anybody speaks in terms of absolutes in the equity markets, you know what I do? As a contrarian, I start thinking, okay, I was thinking that way too. Now I could be wrong. Now I gotta take a step back and keep a more open mind than what I had. So because the consensus is just too broad, and the street will take advantage of that. So we're going to talk about that more in a moment. So stick around. Okay. Which is the best way to buy silver? So if you're buying it for an investment and you need to pay the border guards, if you think that what's going on in the world is going to get worse, you got to have the physical silver. If you're looking at it from a swing trading or short-term investing perspective, and I'm using the AGQ. That's a leverage product, gives you a little bit more spice than SLV. So that's what I use. But as an investment, I want to have that product in hand. I like the physical. I own the physical gold. Okay. All right. So let's get to it. We have a lot to go over here. Okay. So I want to begin this with this is the Barron's article or headline for March the 11th. This is coming out tomorrow. Bet on the bull. All right. This is, a lot of people treat this as tongue-in-cheek humor that it doesn't really mean anything. It means something. I have a couple of examples tonight to go over. One of them, actually two of them, still bullish. This was back in 2000. The top was already in. And Barron's is all about being bullish. Dow 14,000. This is in 2007, 2008. Then we went into free fall. I don't know why this is up here. That was 2013. That was actually a pretty good year. But I'm not sure why that's there. I think that may be a test. But it's interesting that Barron's on the following Monday that we have a nasty sell-off comes out with this being their headlines. I don't know. It doesn't give me the warm and fuzzies about being bullish on the market. Let's talk about the Federal Reserve and their expectations for a rate ease in June, 70.7%. This is down a tick from yesterday. And in July, that's about the same as yesterday, about 90% probability of an ease. So they're looking at June, July as the beginning of rate cuts. The only problem I have with the argument they're going to do rate cuts is this. If we have a 3.2% GDP rate, why do we need rate cuts? Rate cuts on a historical basis are about normal. Why do we need rate cuts? It's because the data that came out last week, the jobs data, do I have it up here? Here, last week's. Non-farm payrolls. They were expecting 198,000 new jobs. Reported was 275,000, okay? So let's pause there. 2 points to make here. One, This is the revised number from the prior month. This has been revised down by 125,000 odd jobs. Remember that month, the month of January, we got that non-farm payrolls hot number. The markets went like this. Never look back. So then what they do is they revise them down the following month. They've been doing this at the BLS for the past 2 years. Hot number on the headline. Next month, they revise it down. You could bet your bottom dollar that this number here is going to be revised down to this number or lower next month. Also, second point on this jobs number. The jobs growth came in social services growth, 2 in government growth. So basically, non-producing workers. Sorry if you work for the government, but I'm sorry, you're not producing output. It's actually a cost to the taxpayer. So the government continues to get larger. What must that mean? It means that the government's deficit spending must continue to get larger. They need to borrow more money to pay them. Earlier in the week, we had, this wasn't actually a bad number. This one was pretty good. But factory orders, holy cow, abysmal number. They expected a negative read. They really got a bad read. ADP employment missed. So the jobs data is probably not going to be good when you look in the rearview mirror this time next month when they revise it down. All right, so coming out this week, we get CPI this week, folks. Now, if it comes in with a miss, this may be your opportunity to buy gold on the pullback, because a miss would probably result in the sell-off in gold, a buying of the dollar. It would also allow for equities to rally, because there's no fear of the Federal Reserve having to raise rates, or at least push back their rate cuts to a later month. Retail sales comes out on Thursday. Core PPI, that's inflation at the producer level. Friday, we get Empire State Manufacturing Survey, import price index. This is another measure of inflation. Remember, we import a lot of our goods. So this is important. Import prices, and of course, more consumer sentiment data. So a pretty heavy week in terms of economic data coming out. I don't see anything by the Fed. I don't see any Fed governors out there giving speeches. Oh, and this is the NFIB Small Business Optimism Index. That's pretty important. Watch the small caps on that read. And mid caps. Schiller PE ratio, 34.26 relative to the mean at 17.10. That's on a trailing basis, full rearview mirror basis. On a forward-looking basis, the forward 12-month PE on the SPX is 20.7. It's above the 5-year moving average of 19 and above the 10-year average of 17.7. So going into the new trading week, even though we had a sell-off on Friday and the markets were down last week, was still very expensive. The S&P is expected to report year-over-year earnings growth of 3.4% for Q1 of 2024, which is below the estimate of 5.6% growth in December on December the 31st. So this market bottomed out and began its rally in October. The projection for growth at that time in earnings was 5.6%. It's been ratcheted down, yet equities have done nothing but move up higher. It makes this a vulnerable market. The traders aren't paying attention to the underlying sea change that's going on here, and it just makes the market susceptible to days like Friday. Looking at seasonality, the month of March is typically a good month. April, a very good month. It's tied for the third best month out of the year on the S&P 500. What I want you to pay attention to, though, is the weekly chart. And we're heading into 2 weeks where it's not the best. 50-50 is not the best odds for anything, especially when you're trading in the stock market. So the next couple of weeks, get ready for a bumpy road, and then we go into April, and seasonally it's pretty strong, unless, of course, we get some sort of a binary event in the equities market, and this bubble just comes tumbling down, just as it did in 2000. We'll talk more about that in a moment. So here was the chart of the markets on Friday. Everything that drove the markets up higher brought them down on Friday. What was up? The laggards. Apple, Google. What was Tesla? Tesla was down. Amazon was down. Tesla's technically been a laggard. It hasn't broken out to new all-time highs. So this is the heat map. We saw a little bit of weakness in the drug names. Buying of real estate, as I mentioned earlier. Real estate, energy, money was rotating in there. We're going to talk more about utilities in a moment. Money was rotating into utilities. These are all defensive plays, cyclical plays. The question is, does it last? Were traders just parking money in there? So this is significant. This is tech outflows weekly and a 4-week moving average. So you can see tech flows. This is the biggest bar of outflows out of technology, at least in the past 10 odd years. I mean, really a dramatic chart if you think about it, with all the big time frame that you have here. And this is on a 4-week moving average. So not insignificant. So let's talk a little bit about, everybody's seen these charts, but this is from Alpha Trends, Brian Shannon's organization's outfit. So this is pretty good. I need to expand this a little bit. All right. So here's how it works. All right. So you're in decline. There's 3 phases of decline, and then you go into accumulation. Right? That's when people are climbing the wall of worry. They don't want to buy stocks. They're still living in this world back here where the institutions are accumulating in the new bull run because they have more data than you, and they're in the know. Then you get into the markup phase. That's where the market is now established, and that's where we find ourselves now. And I would say that we are straddling phase 2 and 3 of this markup period. And I'm going to try to read this. The mid markup period, pullbacks above the rising longer-term average may become deeper, but the stocks are often in the sweet spot of an uptrend where gains come quickly. Right? Valid point. But here's where the NVDA-like stocks come into play. And that is the upward momentum is still present, but rallies may take longer to develop after pullbacks. We're going to know this coming week. Gains can come very quickly, and we've seen that, often at the expense of trapped short sellers who have incorrectly bet against the market. So what we're going to be looking at here is going into the new trading week. Do we recover, or do they gap us up on Monday, sell us off by Monday afternoon? We don't know. The one thing I can tell you is that market tops and market bottoms are not usually found in the terms of market bottoms. You don't see a market bottom when you wake up and you see bright green futures. You need a washout. You need a big down, ugly red day. And the same holds true for a big blow off top in the equity markets. Could Friday have been that day? Maybe. Had no reason to go up. You have 3 days, Wednesday, Thursday, Friday, absolutely zero reason why they marked up the futures action. And in fact, on Friday, you had the night before Broadcom and Marvell Technologies come out with disappointing earnings. They were down big in the after-hours session. Yet the futures action spiked up. That was a tell. That was a tell all day long. So that's where we're at in terms of speculation in this current market. Now, I want to take you back here. This is to play off of this phenomenon here. I was trading during this time frame, and this is from Fortune magazine May the 15th, the bubble had already popped, but nobody really knew yet that the bubble had really popped. We were just like in this denial phase. And March 15th, 2000, here's the headline. Is John Chambers, that was the CEO of Cisco Systems at the time, the greatest high-flying stock during that time frame. Forget about Apple. Is John Chambers the best CEO on earth? Is it too late to buy his stock? Again, May the 15th of 2000. Here's the chart of Cisco Systems back in March of 2000. This was the parabolic blow off top. We had done a pullback to a support level on March the 16th, and then we rallied over the course of the next 7 trading days, 55.5%, a little bit more. That's pretty impressive, right? Surely there could be nothing that does a comparison with that now, is there? Well, let's check that out. Let's take a look at NVDA. NVIDIA, this is current day. It recently bottomed out on February the 21st, topped out on March the 8th. During that time frame, which was a 12-day run, we went up 50%. So it's pretty consistent with the blow off top of Cisco Systems. Now, that's just an observation. There's no guarantee that that's going to be the case. So don't take this as me being the guy saying, hey, you got to go shorting Cisco Systems, NVIDIA on Monday morning. No way. No way. We're not ready yet. Because I want to bring you back to 2000 in a moment. But first, I want to take a look at the NASDAQ composite and what it did on Friday. Here is the bearish key reversal bar. And we did it on not that bad volume. It wasn't horrible. Let's take a look at a comparative chart going back to 2000 NASDAQ composite. Did we see any instances of bearish key reversal bars back then? We did. Here. January 24th of 2000, pulled back, rallied. Again, we saw it February 11th of 2000, rallied. Then we saw it again on February the 18th of 2000. Then again, we saw it here on March the 7th. That was it. That was generally, truly the top. The market just didn't know it. You got a last short squeeze, shooting star formation, end of statement. Market was done. So for those out there that think that this market can't go up higher, you're making a mistake. It can go up higher. It can go into denial. It may do it on declining up volume, and it didn't do it back here, but it could still do it. So be careful. If you're going to go shorting the market, leg into your position. Know your tight stop loss order, because we can break out to new higher highs. Now, what could threaten this market? On Thursday night when we went live, I was talking about the yield curve, as I do pretty much every week. And at that time, we were down on the week. By the end of business on Friday, we had closed unch on the week, flat. This is a problem. I'm willing to speak bullishly about this market, but one thing I will not ignore is if after a breakout on the yield curve back here in January, we do a pullback, February, another pullback, March. Folks, that's setting up for a continuation rally. And for those not familiar with the yield curve is, in short, if you're bullish on the stock market, the last thing you want is the yield curve steepening. You don't want it happening. You certainly don't want it happen. You don't want, you don't want to have it inverting. Uninverting. Sorry about that. So what happens when you get an uninversion of the yield curve, overlaid here in gray is the S&P 500. It rolls over. This is 2000. Back here, financial crisis, rolled over with the steepening. COVID, same deal, rinse, wash, repeat. So get ready for a possible rally here. And another way to illustrate this rally, this is another view of a monthly chart of the yield curve, 2s versus 10s. I got to tell you, it's looking pretty bullish. It's holding support, and it looks like it's getting to ramp up higher. And guess what's ramping up higher along with it? Gold. Safe haven plays are ramping up with it. What else is going up? Bonds. These are the trades that go up when the yield curve steepens. They're flight to quality trades. So this is just another example of what we're looking at to identify, is everything okay with this market? Just because we rally on Monday, rally new all-time highs on NVDA, hit $1,000 on Tuesday, Wednesday, Thursday, whenever it happens, if it happens, doesn't make the market a healthy market. It just may be a market that's in absolute and utter denial, especially if it's rallying and you have the yield curve, which is now breaking out. That's a problem. And then you want to take advantage of that strength in the market, take some profits off the table, maybe buy some bonds for safety, and or look to get short of the market. Now, there are plays out there that are looking pretty good. These are ratio charts, utilities versus S&P 500. So are the utilities underperforming or outperforming the S&P 500? Let's take a look. We spoke about this a couple of weeks ago, and the utilities were breaking down. But now we appear to have flashed early in the month. A lot can happen, but we have a bullish key reversal bar. I'm calling this a bottom on utilities versus the S&P 500. I would be a buyer of the utility names. We own one. It's a speculative bet. That's Hawaiian Electric. I bought that on the Maui fire issue. I would not buy that, by the way. That's a speculative bet. But you take a look at the utility space, it looks as though it wants to break out. Why would utilities break out? Why would we want to buy them? It's because if the Federal Reserve does cut rates, what does that mean for utilities? Well, utilities are capital intensive. What do? They're always issuing bonds constantly. So if bond prices or treasury prices come down, well, they're viewed as the creme de la creme of equities or bonds. So that means that the pricing of the bonds out of utilities, that can come down as well because they're viewed as a more risky bet than treasuries. So all that savings of interest payments goes to their bottom line. So you have capital appreciation, and then you got the yield. I don't know what the UTIL is yielding here. This is a leveraged product. Oh, that's not the leveraged product. This is the Dow Utility Index. UTSL is the leveraged product. This has got no yield. Let's take a look at XLU. That's the index. That's why it's got no yield. 3.36%. So people will be chasing yield as yields on treasuries come down. They'll be going into the utility space. Other areas looking really good. Here's the gold ratio chart versus the S&P 500. Gold is now outperforming the S&P 500. 1 month does not make a trend. However, it's looking pretty good at current. And when we take a look at gold and how it's trading at current on the month, it's looking really strong. New all-time record highs. Take your crayon out. Draw those trend lines and enjoy the ride up. What else are we liking here? Silver. We talked about this earlier. This is the mother of all cup with handle formations on silver. And right now we are bouncing off, or we have bounced off the lower band of support. This is a multi-year consolidation. So when this breaks out, you got to expect that this is not going to look back for a number of months. It's just going to be a straight shot higher. So gold, still pretty inexpensive relative to excuse me, silver relative to gold is inexpensive. So this is looking pretty good. Let's take a look at it on a weekly chart. Looking awesome. Inverted head and shoulders setup. Left shoulder, head, right shoulder, neckline up here. I'm probably going to be buying more silver tomorrow. Lastly, if you're not looking at the gold mining stocks, you're making a major mistake. Keep in mind something. Inflation has caused gold miners to shut down production, but demand for gold is picking up. So they've shut down production, cut down debt. They're running lean and mean. So now, in order to fulfill production, well, prices got to go up. And they're going to have to open up new mines to provide that demand or that supply for the demand. So the gold mining stocks are looking awesome. This is a monthly chart. We have broken out. We broke out back here in November, multi-month retest of the breakout point. Folks, we're going up higher. So gold stocks, silver, gold. I mean, it's all looking wonderful. And the beautiful part about gold right now, there's no overhead supply above. Right? No sellers looking to get made whole. So we're loving this space at current. We will be adding more members. I will be sending out an alert when we do. Let's go to some comments and we'll do some chart requests. Jody, welcome. Michael, HPE. I don't know what HP is. What's HPE? HPE. Oh, Hewlett Packard. Wasn't it HPQ? Or did they do a breakup of that company? Yeah, they must have done a split on the company. I haven't traded Hewlett Packard since 2000. Buy stop for which bad boy, the possible triangle formation upside. It's breaking out. It's going up. Watch the dollar. Let's just check back in real quickly with the futures action. We're still up relative to the close, even though this says we're down. Same deal with NQ. Volatility is up. This is going to be an interesting night. You have volatility up and the futures up on equities as well. Okay. Let's check in with gold really quick. That's not gold. All right, down slightly at current. All right, that's good. All right. Folks, we're going to be using TrendSpider, automated technical analysis. If you're not currently using it, you're missing the tool out of your toolbox. Minimum 35% discount code below in the description box. All right. I have a bunch of stocks to go over here. Jeff, Donnie, Apple is number one. All right, so Apple, I think, is dead money. We were up on Friday. The trend is clearly to the downside. Volume last week was very heavy. Daily chart. Looks like we put in a little bit of a consolidation. We got a rally here. You know, might we rally back up to 177.74? Sure. After that, I think it gets sold and it goes lower. I am not a bull on Apple. I think it's got a lot of problems. China, new products, etc. It just keeps building. IONQ. I don't know what this is, but we'll look at it anyway. Let's go to a monthly chart first to get the vibe. Monthly chart looks interesting here to me. Let's throw some lines up. At current, we are attempting to break out in a monthly time frame. Remember, we have a lot of time left in this month, so we don't know if it's going to close above that support level. Support at $9.73, weekly chart. You can tell by these wicks, shadows, topping tails, call them what you want, doesn't matter. You have a lot of overhead supply here. That's what the charts are telling you. So I think this could be bought. I would really like it a lot more on a ruthless pullback and a retest to a $9.73 mark. May not get there, but it's worth keeping an eye on. Daily chart. Bearish reversal bar on Friday. Expect a retest of a minimum $10.40. There, you should start looking to accumulate a position. Stop loss right down below these lows here, $9.28 around there, and I would get out. But I would stay very, very small on this pullback, add more once we start getting through this overhead supply at around $11.68. TME. 10-cent Chinese stock, I believe Chinese stock, which is frankly looking pretty good. You have a Bollinger Band squeeze here. In black, you have the Bollingers. In green, you have the Keltner channels. This has been resolved, and it's been resolved to the upside. So you have a higher low getting put in, and we have broken out of a consolidation. We're going up. This is going up. Weekly chart. We've gone up. We have resistance up here, $11.26. You don't have a lot of risk reward here. I would wait for a pullback, maybe down to $9.69. If not, $9.05 on a market shakeout. Daily chart. We tap resistance immediately above. Let's overlay weekly support above. Or resistance, I should say. Right up here. So you have resistance levels up here. I think you need to do a little bit of a consolidation. I'd be a buyer at $10.45 and add more on a breakout. I would stay small on that pullback. Rivian. This is a very speculative stock. Monthly view. Still in a downtrend. We are holding support at around $10.45. So this is clearly a speculative bet to the long side. I would not short it. No breakout on a weekly time frame. I would need to see a breakout out of this wedge formation. Right now, it's anyone's guess which way this thing goes. But I do think that the odds favor bulls. I'll give the odds to bulls. Good volume. You're seeing some accumulation here. Daily chart. We broke out on a daily time frame. Odds favor bulls here. I would be very small, buy on strength. All right, we have CrowdStrike. CrowdStrike is all about where we find support. So to do that, let's take a step back here. Let's go to a monthly chart. It's a great, great company, but it's also very expensive and very volatile. So the weekly chart or monthly chart is not helping me at all. Weekly chart. I think we need to test 300 each share. I think that we need to print a 200 handle before it's safe to go back in the road. Just keep in mind, that the VWAP, which we tapped last week, is still at 292. So we could easily do a retrace back down to the support level, especially if this market begins to break up. This is easily going to fall apart. And on Friday, we flashed a bearish key reversal bar. The best thing that could happen to this stock is that you get a few days of just horrible selling. Then keep an eye on the market. If the market holds up, find support. I'd be a buyer down here. Let it print another 200 handle, and I would get involved with it. Not until then. Too speculative. I would sell premium, deep out of the money strangles or iron condors. We have NEM, Newmont, gold mining stock. You know I'm bullish on the mining stocks. Monthly chart. I mean, we're just bouncing off of this guy. This just caught a downgrade right when gold broke out. Newmont caught a downgrade, and that's probably the bottom, typical of Wall Street. So I think that this is a buy. I think this is going up higher. It's a best of breed play. Weekly chart. Nice breakout. I think it's going up higher. Good volume. Daily view. I like it. I like it. Especially if the dollar breaks down. Newmont, bullish. What else do we have here? Anything else? Okay. PLTR from Mike. We're going to leave it off with this one. PLTR. Palantir. Strong stock. The question is, does it hold this retest? We broke out above this rising uptrend channel. And this month, a little bit of a struggle. We're still above it. The question is, do we hold it or do we fail? If we close down below 25 bucks a share, I would avoid the price. And when I mean close below, I mean by the end of business, final trading day of March, we close down below that mark, 25 bucks a share. I would avoid the stock. Weekly view. Strong stock. Again, it's going to do a retest this week. The question is, does it hold? Daily chart. Consolidating. If the equity market finds footing, I think Palantir moves up higher. If it weakens, I think Palantir just goes along with the rest of the market. It's not no reason not to buy the stock. I mean, if you're buying it for dividends, you know, you can look for another stock that's got a better dividend play. But if you're looking for upside appreciation, Newmont Mining is a very good play to trade or just buy an ETF. All right, folks. Everybody have an awesome, profitable trading week and a great evening. Thanks for being here. Like, subscribe. You know the deal. And I will talk to members tomorrow. Be well.